Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to go over a little bit of a breakdown in the November 2021 CPI. So the month-over-month inflation rate for the Consumer Price Index came in largely in my realm of expectations. I was expecting about a 0.7% increase. I got 0.8, and that brought over the year-over-year percentage change of the CPI pushing close to 7%. And as a matter of fact, in the way that we have been tracking since we've been coming out of the pandemic back in mid-2020, when we take those inflation rates, we're looking to push over 7% on the consumer price inflation rate annualized number by the end of this year. So that is it's quite a big number. And as a matter of fact, I'll show you in a chart, that's the biggest number that we've seen since the 1980s. Going over the prediction model that I use, which is based off final demand, I was predicting a month-over-month jump of 0.5 in the middle range, and going above and below by 0.5%. I secretly thought that we would probably get a little bit higher than that 0.5% because the consumer price index as a percentage of the PPI final demand, when you overlay the two indices together, it was a little bit on the lower end right there. It usually is tracking with final demand very closely, as evidenced by this 100% line threshold. And whenever it tracked below, it never went below 98%. And then if it did, after maybe a year or so, it would track back upward with the final demand. So we're beginning to see a little bit of a pushback on that consumer price index as it is overperforming the model a little bit. And so looking forward, we're probably going to see another overperformance on the model for December's numbers, and I'll have that prediction out probably tomorrow when the producer price index reports come out. So that'll be another vid that I'll produce for this video. And guys, right quick, I need to apologize for being on a hiatus for the last 2 weeks. I've just got settled into my new house. So I will be back to pushing out videos, and I'll probably be pushing out one if not every day, every other day, as I play some catch up. I have been looking and keeping track of what's been going on in the economy and markets right now, and I've got my thoughts together in large part on what's happening. So there's a lot of crazy things happening here. And when we look at the consumer price index on an annualized basis, we're at 6.9% inflation for the year, and that's the highest annualized inflation rate that we have seen in the aggregate indices since 1982. So we have to go all the way back to the inflation crisis of the late 70s and the early 80s to see annualized inflation rates of this magnitude here. Now, normally this would have huge ramifications for the economy, such as a crashing stock market from its lofty valuations, rising interest rates, lots of bankruptcies, and a potential recession. But special circumstances have basically kept that from happening, and I am going to produce a video on that sometime in the future. When we look at the core CPI, we notice that it tends to lag behind the CPI and has been doing so for the last 20 to 30 years. Core CPI, though, is at 5%, just right underneath 5%. And that's the highest core CPI annualized rate since the early 1990s. And the Fed likes to highlight that the core CPI, which excludes so-called volatile components like food and energy, as if food and energy are not vital components to human living, and use that as its real tracking inflation rate. As a matter of fact, they use their own version based off the PCE, the personal consumption expenditures, which even understates the inflation rate even more so than the core CPI. But now with core CPI now at the highest level that we have seen in 30 years, the excuses are basically over for the Fed. And Jerome Powell has pretty much come out and admitted that the transitory inflation scheme is over. It's not transitory. It's now stubbornly persistent. So while the Biden administration is still acting in sheer willful ignorance and stupidity, lying to the public and telling you that these inflation numbers have nothing to do with monetary policy, my data tends to show otherwise, because basically I've aggregated this prediction, and I've been predicting this for the past 6 months, that we were going to see these high levels of inflation push this year just based off of monetary and fiscal policy, as evidenced by debt accumulation and money supply growth, which Again, the only legalized money printer in the United States is at the Federal Reserve, owned by the government. Part of the reason why core CPI tends to lag behind is because the shelter component in that core CPI is still lower than the annual inflation rate. So while the shelter component, which is housing, rents, and lodgings, is at a high level, with the highest that we've seen since 2007, the annualized inflation rate is still 3.9%. And when we've seen from private sector indices of housing increases and rental increases, this number really tends to understate that inflation component of the shelter index, part of the consumer price index. And I think that we're going to see this continue to push up. As a matter of fact, some months ago I produced a video on this. You can check my channel for it, on the shelter prices, and here it goes. I was looking at that just based off of the rising inflation rates that we were seeing already out of the Case-Shiller private housing report. It was going to have this effect on the shelter component. It would push up to about 6.4% sometime in early 2023, and that would have an effect on the CPI by pushing it up by, say, about 2.1% or so. So that's definitely still in the works, and right now we're still seeing housing prices accumulate and going higher. So that's definitely a concern right quick. Taking a look at the detailed breakdown of the CPI, the inflation rates are going up all across the board. So the excuse that there's been one or two items that's been driving up the inflation numbers, that has to be thrown out the window. Energy prices jumped by a whopping 3.5% after going up by 4.8%. Yeah, a lot of it has to do with the price of oil and motor fuel. That's true. But when we take a look at even energy services and utilities, those are going up at an annualized rate of 4 to 7%. And these kinds of jumps in the energy prices will most likely continue as we go into the winter season, as we start consuming more and more energy. So, there's definitely some international components going out right now. OPEC has signaled that they're trying to ramp up oil production. Oil prices have stabilized in large part. There's fears of COVID going around. So while the world decides to shut down and temporarily drop off their consumption of oil, that might stem some of that price increases. But then we turn right around and we see food prices go up. We see food prices go up in grains and breads. We're seeing it go up in meats. We're seeing it go up in dairy. We're seeing it go up in fruits and vegetables, alcoholic beverages and non-alcoholic beverages going up. Everything's going up. And even when we go to restaurants, that's been pushing up, okay? So, there's been a lot of blame to do on supply shortages and things, but there has been less attention paid to the fact that the increased demand for monetary stimulus has made those shortages worse than what they otherwise would have been. We're seeing clothing prices go up. We're seeing car vehicle prices go up. We're seeing hospital services, medical care services on the aggregate go up. We're seeing transportation services going up. Everything is being pushed up. This is a broad aggregate index. There's really nothing left behind here. Everything is being pushed up on the CPI, and that cannot be blamed on the shortage issues that's going on with the supply constraints. Yes, that might make the situation worse than what it otherwise would have been, but when you're having the CPI go up on all measures, on all accounts, the common denominator has to be the money supply. It's very specifically has to be the money supply, and that's what I'm seeing here. Now, when we take a look at the tables that I have compiled for the CPI right quick, we're definitely pushing this 70% confidence interval right now. So right now we stand at about 71% when we annualize the inflation rates over the last 2 years. And this is in relation to the accumulation of all debt in our economy since the beginning of 2020, as well as the jump in the money supply. And that's definitely correlating with that relationship that I've observed in the CPI for the last 20 years. That still shows that there's a high confidence in the US dollar. So I think we're going to see inflation peak pretty soon, although it could run hotter than this if the supply shortage issues do not relieve themselves, and that's a definite possibility. Offsetting that, though, is a recent surge in the US dollar. So for the last 6 months, the US dollar has surged in value in relation to other countries' currencies, particularly the euro and the yen. And the fact that we're seeing this surge up in the US dollar of, say, 5 to 6% will definitely stem some of these prices as dollars are cycled abroad. A lot of that has to do with the fact that overseas countries have put in draconian measures to try to contain the spread of COVID and has damaged their economy severely, forcing capital to fly out of those economies and into the U.S. Other countries that are smaller than even the big regional ones have suffered an even worse fate with bouts of hyperinflation. Turkey's inflation rate has jumped over 20%. There's indications that China's inflation rate is definitely pushing higher. Lebanon early this year went into hyperinflation. Argentina is in hyperinflation. So as we see more and more countries deal with worse bouts of hyperinflation, that's going to cause capital to fly out of those countries. And sure enough, it'll shore up in the U.S. And this is really evidenced here in our bond interest rates right now. So our 10-year Treasury rates are remarkably holding steady at 1.4%, despite the fact that our inflation rate is pushing 7%. So if we take 1.4 and subtract it off of 6.9, investors are suffering a loss of real yields of negative 5.5% on returns from holding government bonds. That can't continue forever, but the recent surge in the U.S. dollar tells you that there's some foreign demand for U.S. dollars, and that could certainly counter some of the inflationary impacts caused by the supply chain issues, which is really impossible to quantify. But if we were to go off of this confidence interval here with money and debt, then it probably will hold this confidence interval around that 70% threshold. Might go a little bit below, but really shouldn't dip too far below. We shouldn't see a repeat of the 1970s unless if situations start to develop where there's a dumping of U.S. assets and the money starts coming home looking for goods to buy. In that case, we could definitely see a surge in prices, but I don't really see that materializing just yet. We'll have to see just how rapid those interest rate increases happen, and also the Federal Reserve's response to this. If the Federal Reserve responds to high interest rates and high debt by trying to expand the money supply and bring those interest rates down, then yes, the inflation rates could spiral out of control. But the Fed right now, especially with what's going on with Jerome Powell, he seems to have pivoted and is more concerned with this persistent rising inflation, and is certainly at least geared rhetorically to try to contain those inflation rates. So we'll see how that manifests and what kind of impact that has on the consumer price indices. Certainly whatever monetary policy is changed right now will take a year or two to develop. And as a matter of fact, when we take a look at October's money supply growth rate, we still jumped at a 0.9%. And the money supply growth rate that we have averaged ever since we've gotten out of COVID has been about 0.96%, or about 1% increase in the month-over-month money supply every single month. So that's got to come down drastically, okay? That has really got to come down. In order to bring in the inflation rate down to 2%, that money supply will need to drop down to, say, 0.7% or so with that. But in tandem with that, low interest rates have fueled a debt borrowing binge. So debt has increased even faster and at a faster rate than the money supply. So the usage of such money, there's being less money saved, more money being borrowed, particularly on the federal government level. And as that money comes circulating out into the economy at an average of 1.4% per quarter, then that's definitely going to have an inflationary impact on our economy so far. So lots to go over there. There's a lot that's really been materializing there. And as long as we continue to see large amounts of debt increases and money supply increases, then this situation will remain. Now, I've got the average annual inflation rate at about 4%. So, over time, we might see some calming down in the inflation rates, but that probably won't happen till the latter half of 2022. And again, that's assuming this high confidence in U.S. dollars. So we'll see how that manifests and how that plays out. Tomorrow, I'll give you a breakdown on what I'm expecting for the CPI for December when the producer prices come out, and I'll do a projection chart out of the producer prices for the rest of the year, much like I did with the CPI. And that's all that I've got for this video, guys. I thank you for watching this. If you like my content and the things that I provide for you, make sure you like this video, subscribe to my channel so that way you are automatically in the feed whenever I upload a new video. Click that notification bell. You'll be notified on your devices whenever I do upload a new video. It will definitely show up in your YouTube feed, and then you'll be able to view it as soon as possible. And there's a lot more that I'm going to be producing that's going to be coming out in the coming weeks. So a lot to go over before the Christmas holidays. So I hope to get that pushed out fairly soon. And as always, I thank you for watching.